Hello, my name is Tristan Harty and I'm the Managing Director of Harty Wealth Management. Today I'm going to be interviewing John Jones and William McBride, the two fund managers at our fund management side of our company, 24/7 Investment Management. Today's interview is basically just going to be an update on the last 4 months of what we've done to change things within your portfolios and what we think those changes are likely to occur and mean. So I hope you enjoy this update. Hello and welcome to our update with 24/7 Investment Management around the investments that Harty Wealth Management use. We sent one of these out about 4 months ago or so. So of course, time flies pretty quickly and a lot's happened. So we are now going into our next set of changes. So we've got Will and John here, and we're going to go through the same sort of conversation we did last time, which is sort of what's happened, what they're changing within the portfolios so that the performances can continue to do what they've been doing for this year, which has been very good so far, and then where they think that's going to go. So I think we'll start off by just going with John, just to do a brief roundup of what sort of happened over the last 4 months.
We'll start with the markets. So the markets generally in Q2 followed suit of what happened in Q1. Equities around the world were on the forefront. Alternatives, gold in particular in Q2 performed well. And the fixed income basket, it's still yet to kick on. We'll get into that in a little bit more detail later. It's not necessarily a negative. It's just the goalposts have slightly changed. It's still predicted for the second half of this year to kick in, which we'll get into later. Flipping back to portfolios, as the half year 24 is up to date, all portfolios are positive. All portfolios are beating cash, which has performed around 2.5%, except one portfolio, which is defensive. That's just because it has such an overbearing into fixed income, fixed interest. That's yet to come into play. So positively speaking, portfolios performed well. As I say, equities are on the forefront. Stock markets around the world, quite a lot of them are hitting all-time highs or near all-time highs, which is good on the face of it, but it is a slight cause for concern, and it's something we're now monitoring on a month-by-month basis of whether to tilt downwards and take equities down. It's not a decision we've made as of yet, but it's something on our watch list just because equity markets have performed so well. So we're just conscious to keep an eye. We'd normally keep that on a quarterly outlook, but we use indicators, but we're using that on a monthly outlook. But that's where they sit as of right now. On the fixed income side, I know the question's going to be when a rate's going to come down. We've started to see a few rate cuts around the world. Switzerland, Sweden, Canada, they've all initiated a first cut. So that's a good sign of things to come. That alongside with inflation falling, the UK headline was 2%, which is good. There's a little bit of stickiness in core inflation and service inflation, but the Bank of England's predicting the first cut, which the market's estimating 0.25 percentage point in August, September time. So it's upcoming. Granted, we know we said at the start of the year there may be 3 or 4 cuts. The market did predict that. We're now looking at 1 or 2. The Eurozone has cut, which is a good sign, and they cut by 0.25 percentage point June, so they're about 3.75%. And the US is predicting a cut again in Q3 as well. Yeah. It's not a bad thing that the cuts haven't come. It's because the economies have been a little bit stronger than expected. So the US has performed well. The UK's held up well. It's a matter of if. It's a matter of when, not if, sorry. Yeah. And we're predicting second half of this year, Q3, for the first cut to come.
Well, let's hope so. Yeah. Will, have you got anything else to add?
Yeah, I was going to say on the back of what John said, sort of fixed interest had a really good rally towards the back end of the year. It was 5% in November, December. This year it has been flat because, as John said, there was a lot more rate cuts predicted. That's been pared back and it's only been a couple. So we're still sort of waiting for that fixed interest returns to come through. And it has been pretty much just equities driving the portfolios year to date on that side.
Yeah. Great. Okay, so that's sort of looking backwards. What are you changing I know you've changed it this week. So What is it that's changed within the portfolios that's sort of hopefully going to prepare people for that rate cut, which will help that lower sort of risk element of the portfolio?
Yes, it will. Yeah, leading on from that, the first sort of change is that we have trimmed cash money market funds to reallocate to fixed interest to try and pick up that sort of, hopefully, the capital growth. Once the interest rates start to dial down, you should see a little bit of capital upside. So that's the first thing. So we have trimmed cash. The other thing, we have sort of changed composition of the equity basket. We've dialed up emerging markets, Japan and global equities. reduced UK a little bit and took profits from Asia.
Okay.
Side of things.
So why have you reduced some of the holdings in the UK side?
Yeah, domestically, UK is a really good market for income generation. Hasn't returned as well as global markets, but it is a really good sort of foundation to get that income. But we just thought we've had a bit of a rally in the UK markets. Let's take a little bit of profit, let's trim it down and increase the global basket.
Makes sense.
Of these.
And just to follow on from what Will said on the UK, if you take if we zone out a little bit, the UK only accounts for 3 to 4% of the global stock market, whereas the US is 60+% onwards. So we still have an overweight to the UK because we do like it. As Will said, dividend payer, it's more stable, it's a little bit more contrarian, focused on balance sheets and value. So we still have a nice healthy weight to the UK. We just did have a slightly higher weight.
Yeah.
So when we say reduce, we've still got a lovely allocations to the UK, but we've just allocated a little bit more globally.
Yeah, let's say I think the currency as well, because if you're a domestic UK investor, you want some of your own currency. 'Cause
Exactly.
You could be in the Japanese market, the yen fluctuates, and you could lose out on returns just by the fluctuating currency.
Yeah.
So you need to have that sort of base UK holding.
Yeah, so I think the equity basket sits in quite a nice range. Now, we've just finished, as of this review, as I'm speaking, our final step up. So we've done an 8-step process to increase over time rather than doing it as a one lump sum increase. If you do it as a one dial, say, you're taking the risk at your time in the market, but by doing it gradually, I think it's over about 2 year, 18-month, 24-month period, you reduce that risk.
Yeah.
So now we've finished, as of now, we're happy with the global allocation.
Yeah, I think we prefer that approach, just gradual sort of changing over time. Instead of just making a big call, you could miss out, you could get whipsawed between the different markets.
Granted, you can get it right. Say you bought in at a lovely low point, but granted, you can get it wrong. So it's just a bit more logical and pragmatic that we staggered it.
Well, phasing it is something that we obviously talk about quite a lot with all the clients and so on. Anything else that you're sort of changing?
Yeah, we increased the gold allocation back at 1st of March, and that's seeing a big upswing. It's up sort of 32% since the 1st of March. It's obviously gold miners, so it's quite volatile. So we're paring that back. We're just going to reduce that down a little bit, bank some profits, increase sort of real estate and infrastructure in that alternative basket.
Okay.
Which seems a sensible approach. I mean, gold's sort of near record highs, so I don't think it's a bad idea to take some profits there.
And exactly on the back of what Will said, when we see the first interest rate cut, property should naturally get a boost. So we're investing in a global property fund, obviously heavily in America, also UK and Europe. So when the rate cuts start to take effect and we are on the downward path towards a more stable interest rate on that journey, property will naturally have a bit of an uplift.
Yeah. So what I'm hearing here is a lot of it is down to when those rate cuts come.
Yes.
So
Yeah, cash rates are still high, still nice, but the future looking is capital appreciation, is growth in fixed income. You don't get any of that in cash. When the rate cuts come, the cash rate will go down. You've got no upside. It's a bit of a balancing act, but we've got to look forward of that. We can't be behind that.
That's it.
You've got to be slightly in front, of the first cut. We can't be reactive. We've got to be proactive.
Yeah.
And I know that means I do appreciate a little bit of sometimes pain up to that point, but once it's gone and happened, you've missed it.
Yeah.
So you've got to be in it.
and it's pretty much guaranteed the rates are going to be coming down.
Yes.
Yeah.
Yeah. But all central banks are keen to get to a certain level of rate. They won't publicly say the figure. It might be different to the decade that's gone by, but they'll be keen to get to more of a stable rate where they hit a figure and try and keep to it.
Yeah.
Whereas at the minute, 5.25% in the UK is a little too high.
Yeah.
We're going to be looking around the 3% marks, hopefully, for a stable rate.
Especially with inflation ticking down, it's sort of round about the target they wanted. Obviously, service inflation.
There's metrics behind the headline inflation figure. So the headline inflation figure is great. We want to get to a 2% CPI, but the service inflation behind that, and that is in the 5% plus range. I think the Bank of England are keen to get that slightly lower, slightly more controlled before they start cutting. The worst case scenario would be they enact cuts and inflation spikes back up, and we have to repeat the cycle again, which would not be good for markets.
No, it wouldn't, or mortgages or anything like that.
Anything, pretty much.
Yeah.
But I guess it sort of leads into, so they didn't do one in sort of June, the Bank of England, and they said that was because of the election, which leads into that. So what's likely to happen over the next sort of 6 months? I know we don't have a crystal ball, but we might be able to see a little bit of a trend that's likely to appear.
Yeah, I'll jump in first on that. I think I'll get to the election and the impact on equities in a second, but with the election result being definitive, I think that gives stability in the market, regardless of which party got in, left or right. There's stability. And if there's one thing markets like, it's stability. And if there's one thing markets hate, it's volatility. And anything they don't know creates volatility. So at least we've got the stability of there was an election. It was quite an overriding win. That's that. So now the focus will predominantly, if not almost 100%, be on the rate cut. I foresee 1 or 2 cuts in the UK. All things being said, that is still caveated with data-driven, monthly data drives. But yeah, 1 or 2 rate cuts this year, and it should follow suit next year with into 2, 3 or 4 cuts, all being well if we still follow the inflation path downwards.
Yeah, sure.
The only negative would be if there was a growth shock. So or there was an unemployment shock, that would cause rates to maybe come down a bit quicker.
Yeah, no, I agree with that pretty much.
Yeah.
Same from my side.
Anything else that you think might occur over the next few months?
No, I'm pretty much on the same track as John, really. It is, at the start of the year, it was predicted a lot more cuts. It was going to be more severe, but it is seeming like 1 or 2 cuts, I think, because the ECB have gone first in Europe. And we're just it's either August or September for the UK as the first cut. So it's getting closer. It just seems to be the can has been kicked down very occasionally. But I think we are getting closer to that now.
And also the Fed, estimated to be a similar time to the UK. The Fed over in the US, they have a slightly more difficult role. Obviously, the Bank of England won't like me saying that. They've got 2 mandates to abide by. They've got to look after growth and inflation. And with a US election coming up, that will be at the forefront of the press quite a lot. But the US economy is still growing despite of high inflation and high interest rates. So it's a strong economy. That's where the headaches come for the Fed. However, they do seem to have it under control, and it is following a downwards trend at the minute. So I could foresee a cut or 2, optimistically speaking, in the US. But nothing major in the US, again, unless there was a shock.
And I guess that's the only other major election left. So with it having shown in the past that ultimately elections for the long term don't make a massive difference.
Yes.
Are you anticipating any issues with this particular American election?
Personally, no. One of the positives of the upcoming election in the US is both the candidates have held office. So the globe, never mind just the US, is very, very well aware of the profile of both presidents. And also both presidents have served their time in office under rising stock markets. So they've obviously got a keen eye to keep the US at the forefront of global stock markets, the forefront of growth, just to be a developed world leader. So that doesn't concern me. Who's going to get office? Only time will tell, to be honest. But yeah, you are right. That is the key election this year. But I don't foresee a major swing in markets to a sort of downward surprise, just because we both know the candidates. If the market didn't know a surprise candidate, maybe no one's seen a candidate getting into that position, the market can't price what's going to happen because they have no idea. And then when the reality kicks, that might be so different to the expectation. That's when problems occur. But both Trump and Biden have served terms into the office, and the globe's quite aware. We know the tendencies, we know the political likes and dislikes. So hopefully, touch wood, we know the candidates. It should be smoother than normal. It should be.
I mean, markets like certainty or reality. It's the uncertainty of the UK. Going back to the UK, obviously it was quite well predicted that Labour would sort of get into power. They have. It's a majority. So markets have been quite stable. The domestically focused FTSE 250 sort of risen on the back of last week's election. So it's all positive signs at the moment from that side.
And as you said, Tristan, they don't normally have long-term effects. There's data out there to look at in the masses, but left, right, centralist on stock market gains, it doesn't really have a significant effect. Going back to what Will said is absolutely true. If you look at France, for instance, calling the snap election caused a negative result, and France is down relatively significantly, although it's very volatile at the minute. That shows that the market didn't predict a snap election, and the results from that, the result and sort of variables from that, and that's what's caused the volatility. Not that an election was called, it's that the market didn't see it. And also it's struggling to price who's going to get in on the back. Just going back to our one, as Will said, It was an overriding Labour prediction. That came true. It was almost like that day's done, we move on.
Yeah.
There wasn't really a big market impact.
Not hugely. No, that's
So that was a positive from our side.
yeah.
That's what we predicted. That's what came true. So that was happy. That was one positive from that.
Okay. Any sort of closing remarks from?
Yeah, I'd just like to say we have made 3 specific fund changes as well. Rather annoyingly, we put in a global equity income fund in March. It performed really, really well and got some really high quality fund managers in the team. Unfortunately, on the 29th of April, 5 key members of the team left to start up a new venture. It's just quite a big hit because if you lose one fund manager and you've got a team of, say, 20 analysts managing, but 5 was a big impact on the investment house. So we have decided to change that. You have to sort of take a step back and look, would we invest today, knowing that there's, it's 5 key members left. So we have decided to exit that fund and buy into Guinness Global Equity Income, which is a sort of privately owned company, isn't it?
Yeah.
Sort of the fund managers own shares in the company, so they've been there a long time. They've got a really good track record. It's a really well sort of structured fund. They have 35 stocks, equal weight, and they have a high conviction of, what sort of shares they hold there. So that's one change. In Japan, we've exited a Japanese income fund, which has underperformed. Rather frustratingly, it's there more sort of downside protection, but it hasn't held up as well as we would have hoped. So we've invested in Morant Wright, Nippon Yield, which is they're a specialist Japanese boutique company. That's all they do is Japanese equities. Met fund management team, very happy with their approach, and we quite like the fact they've got a multi-cap approach of large, mid, and small companies across the scale, which have less sort of coverage from analysts, and they sort of become a good yield there on that side of things. And finally, on the European income, we've exited BlackRock in favour of Guinness European Equity Income. We've managed to get founder shares on this, so we're actually saving like 2/3 of the price of the fund. BlackRock was over 1% charge. This is 0.35, so it's a big negotiations because the fund's sort of quite a small size. But again, we like the team. Guinness, well run, similar to the Global Equity Income, similar sort of style. So they're the 3 fun changes.
Great. John, any closing remarks?
I'd only close with, if we flip back to an earlier conversation in the previous video, tactical asset allocation scales, when we have the discretion to slightly dial up or down in a certain asset class, we've remained, all of them have remained how they were. So cash is neutral, fixed income is +1, which we class as bullish, equities is neutral, and alternative is neutral. As I mentioned earlier, we are monitoring equities monthly. To be honest, monthly on the data, but it's a conversation that's brought up many times a week, because that's got the potential to be drawn back. That hasn't happened yet. We've got to be very, very, very strong in our conviction to draw back equities, but that's where we sit at the minute. Bullish on fixed income. Keeping an eye on, we debated going further higher up into the scale, but yields came against us, so it done our job for us. So I'm happy to sit at +1. Take the yield and hope for some capital growth second half 2024 in that space.
So overall, everything pretty positive, hopefully, for the second half of the year.
Yes, very positive and optimistic for fixed income, especially, as you said before, in the lower risk band portfolios that have much of their capital in that asset class.
Yeah.
It's just waiting to start its journey, essentially. It's waiting, and it's frustrating, I know, and I do apologise for saying it because we've said it before. We are waiting for one of the major developed banks, being the US, the Fed, or the Bank of England for us domestically, here, to start their cycle where they start reducing interest rates, and that should have a massive effect on markets, generally speaking, for optimism.
Okay, great. No, well, thank you both, and that's the update for the last sort of quarter, and we'll be doing another one of these again in 4 months' time. So thank you for your time.
Thank you very much.
I hope that you found that video very informative and very useful. If you have any sort of questions or you'd like to get in contact with us, please do so on the usual sort of contact details. And of course, we'll be displaying those at the end of this video. Thank you.